Assalamu alaikum. Welcome to lecture 12 of financial reporting. It's IAS 38 intangible assets. Now, all this while from IAS 16, IAS 20, IAS 23, IAS 40, we have been focusing on tangible asset. Now, we are moving towards intangible asset. It still comes under non-current assets, but it's intangible. Now, here we are going to go through IAS 38 as usual. Scope of IAS 38, definition of intangible asset, applying the definition of intangible, recognition and initial measurement. We'll see the recognition criteria, then we'll apply the criteria, we'll do the initial measurement of acquired intangible asset, then subsequent expenditure, and for internally generated intangible asset, we'll recognize them. Then research and development, cost of internally generated intangible asset, measurement after recognition, that is subsequent measurement, cost model, revaluation model. Then useful life. We determine the useful life of intangible assets with finite and assets with indefinite useful life. Now, impairment and derecognition. Impairment loss, see, like any asset, intangible assets also impairs, okay? So we are going to calculate the impairment loss and then we'll derecognize, and finally the disclosure. We'll disclose, then disclosure of revalued intangible asset, disclosure of research and development expenditure. And finally, we are going to conclude with the syllabus summary and technical articles. So the main objective is to the accounting rules for intangible non-current asset. Okay, we start with IAS 38. Under that, recognition, initial measurement, then internally generated intangible asset. See, internally generated intangible asset is on one side. Okay, then the rest all is for the asset that we have acquired. That is your measurement after recognition, then the useful life, then impairment derecognition, and disclosure. These are for those assets which you have acquired. There are two types of internally generated asset. One that you have acquired, that is easy. One that you have internally generated in your company. Okay, so to recognize that, it is a little difficult, but we'll see what can we do about that. Now, the standard applies to all the intangibles except inventories and your financial asset, because inventories are covered under IAS 2, financial assets will be covered under IAS 32, the presentation, and mineral rights and expenditure on exploration, development, and extraction of minerals. These are intangibles, but they are not covered under IAS 38. Okay. You might say financial asset is also something which you cannot touch. It's intangible. No, but we have a separate standard for that. Same for inventories. Now, apart from impairment, this chapter, this lecture will revise the accounting for intangible non-current asset that you have studied for financial accounting. So this is like a revision of what you have done in your financial accounting, except for the impairment part, which we are going to cover in section 6. Impairment part was not there in financial accounting. Okay. Now, definition of intangible asset. Intangible asset is something which you can't touch. Okay, it's a non-monetary asset. Asset, we all know, control because of past events, and it is going to result in a future economic benefit. Now, these are the examples of intangible assets: patent, your copyrights, license, intellectual property, trademarks, brand names, motion, picture, films, video recordings. Some intangibles may be contained in or on a physical medium. For example, software on a disk or embedded within a hardware. Okay, judgment has to be used to determine which element is more significant, tangible or the intangible. Sometimes with the tangible there are intangible attached to it. For example, software on a disk, your disk is a tangible asset, software is an intangible asset. Okay, things like patent, it is clearly intangible. There is no tangible element to it. Okay, so where you are having both the element of tangible, intangible, you have to use judgment. Which one is more significant, the tangible part or the intangible part? Okay. Now, this activity. So we'll go through the activity 1 to decide whether an item is a tangible asset or an intangible. First one, your operating system of a computer in your personal computer. So this is the solution. The first one is a tangible. Okay. It will be dealt according to IAS 16. Next, off the shelf integrated publishing software package. It's intangible. Okay. Third, specialized software embedded in your computer controlled machine tools. It is tangible. So you will deal according to IAS 16. Next, firewall containing access to restricted sections on your internet website is intangible. Okay. Now, applying the definition of an intangible. So first, if you see the definition, what did it say? It's an identifiable. What does identifiable means? An intangible asset, whether you have acquired in a business combination or you have generated internally, is identifiable when it is separable, when you can separate them. Okay. So it can be separated or divided from the entity and sold. You can divide it from the entity and you can sell it, or you can transfer it, you can license, rent, or exchange, either individually or together with a related contract. Okay. Or it arises from a contractual or other legal rights. For example, franchise agreement, which you cannot sell it separately to a third party. It is still identifiable. If you're having a franchise agreement, it is something you can identify. So this criteria will help you to distinguish your intangible from goodwill that you have acquired in a business combination. See, intangible assets and goodwill is also an intangible asset, but the way you account for intangible asset versus goodwill is different. So we'll keep the goodwill aside. Intangible means apart from goodwill, all the other intangibles we are talking about. So you have to see these two things. Okay. Next word in the definition of an intangible asset was that it was identifiable non-monetary asset. Non-monetary. Okay, see, monetary asset means money held or assets that you are going to receive in a fixed amount of money. Could be cash, bank deposit, your trade receivable. They are not intangible. Okay, they will be dealt according to IFRS 9 your financial instruments because they are finance. Financial instruments are as financial assets. Next term in the definition, without physical substance. There are three terms: identifiable, non-monetary asset without physical substance. That means items which you cannot touch. Okay, the entity may hold a legal document, for example, title to a patent or a trademark rather than that physical item. So that's an intangible. Now, example 1. So intangible asset definition. We'll see through this example. Okay. In your exam, it's very important for you to identify whether an asset is intangible or not. Sometimes it's not very easy to understand. You have to read and see. Why? If you do not understand that it's an intangible asset, you will not be able to apply IAS 38 to it. You might apply wrong standard. You might apply IAS 16 or some other standard. Okay. Because IAS 38, let me tell you, this is based on the experience that IAS 38 is often the trickiest when it is tested. IAS 38 is tricky compared to the other standards. Other standards are straightforward. It's straightforward from the case study. Once you read, you know that, okay, this is IAS 16 or this is something held for sale. So we'll apply IFRS 5. But intangible asset is something which is hidden. It is not very straightforward to identify. Okay. Now, so in 2001, music entered into negotiations to acquire the brand. Looking at the word brand, we know is an intangible from Mellon for 1.2. So they would enable music to sell the product under the brand name and control the development of the brand and open source software. Music did not wish to acquire any other assets of Mellon and no interest in acquiring Mellon as a whole. So now tell me, the brand, this is separable as negotiations are underway to acquire it separately from the rest of the business. See, something which you can purchase separately from the rest of the business is an intangible asset, like in this case brand. So in this case, and it's also non-monetary asset and it does not have a physical substance, so it is meeting the definition. Therefore, assuming the recognition criteria according to section 2, recognition criteria are met, so this will be recognized as an intangible asset in your statement of financial position at the cost of 1.2 million. It is separable, no physical substance, and non-monetary asset. Now, control. What does control means? Power to obtain the benefit and ability to restrict the access of others to those benefits. That means, one, you have the power to get the benefit. Next, you can restrict from anyone else to get those benefit. That is the meaning of control. So, although the expenditure that is incurred in obtaining market and technical knowledge will increase your staff skill and build customer loyalty, okay, they may be expected to generate future economic benefit, but power over the actions of employees and customers is unlikely to be sufficient to meet the control criteria. See, you can't say that you're having a control over your employee or customer. It's difficult. Yes, you might say your customer is loyal. You might build up a loyal customer, or you can increase your staff skill, motivate them, and increase their salary. But still, they have the power to leave you and go to your competitor tomorrow if they want to. So you can't control your employees or customers' actions. Therefore, they are not meeting the control criteria, the requirement, even though you have incurred some expense in order to control them. So control normally stems from the legal right that are enforceable in the court of law. However, legal enforceability is not necessary for the control, as the entity may be able to control the future economic benefit in some other way. If not through legal, then some other way. Now, future economic benefit. So we told there should be control. Next, future economic benefit. Future economic benefit means your net cash inflow. You should be able to generate cash inflow for you and include increase revenue and cost saving. It should be something that increases your revenue and saves your cost. For example, if you are using an intellectual property in your production process, it will reduce your future production cost and will increase your future revenue. Hence, it's an intangible and you have to recognize it. Now, we are moving on to the recognition criteria. An intangible asset is recognized if it meets definition of an intangible asset and an asset and recognition criteria set out in the standard. Recognition criteria are future economic benefits are probable, cost can be measured reliably. This is same like any other asset criteria. That is under IAS 16 also is the same. Then investment property IAS 40 also is the same. So the probability of the future economic benefit should be assessed using reasonable and supportable assumptions with greater weight given to external evidence. You have to see external evidence for this, whether there is a probability of future economic benefit or not. Now, applying it. An intangible asset may be acquired separately, may be acquired as a part of business or internally generated. First, we are going to go through separate acquisition. Okay. So, separately purchased assets. You're purchasing them, such as license you are purchasing, brand you are purchasing. So, when you are purchasing an asset, remember they're always meeting the IAS 38 recognition criteria. That means they're always recognized. Why? Number one, you can identify them. How can you identify them? The fact that you have purchased indicates they are separable. Next, you can control them. Because you have purchased means you are controlling. Third, future economic benefit is also probable. How? IAS 38 will recognize that the price paid will reflect your expectation of probability economic benefit. You have paid a price for it. Why? Because there is a probability of future economic benefit for that asset, intangible asset. And cost can be measured reliably by reference to the purchase price. That is your cost. So these are the four, that's why it will meet. Now, next, intangible asset that you have acquired as a part of a business combination. Because you have acquired a subsidiary, that's why you have acquired that intangible asset, not separate acquisition. Then, if one company is buying another company that is holding an intangible asset, so it makes sense that with that company you are buying the intangible asset also. This will be dealt according to IFRS 3 business combination. Okay, it will not be explained here. This will be explained in lecture 23 when I go to group accounts. Now, the third category, internally generated intangible asset. When a company develops their intangible assets internally, for example, new technology, you have to use a significant judgment whether to recognize them or not. So IAS 38 is introducing more detailed criteria. This they are referring it to research and development expenditure covered in the next section. Next, see, one is internally generated intangible asset. The other one is internally generated goodwill. As I told you from the beginning, goodwill, intangible asset, treated separately, even though goodwill is a part of intangible asset. So goodwill means it could be anything. Let's say a brand name, your reputation, competitive advantage, high employee morale, anything that brings value to a business, which is of course something you can't touch, something which it's difficult to put a value on. For example, how can you put a value to a reputation? Things like that. Okay, so this contributes to the generation of revenue. Because of goodwill, you are able to generate higher revenue. This is created through expenditure promoting. How can you create goodwill? Positive goodwill by promoting, by maintaining a good customer and supplier relation, by providing high quality goods and service, by developing a skilled workforce and experience management. Internally generated goodwill you cannot recognize as an asset because A, it is not separable, nor it arises from some contractual or legal right that is controlled by the entity, and it cannot be measured reliably also. So such expenditure you have to recognize as operating expense. An entity cannot recognize internally generated goodwill as an asset in its financial statement because IAS 38 does not permit the capitalization of internally generated goodwill. You see? See, internally generated goodwill will always be operating expense, but internally generated intangible asset you can capitalize. But we'll see that in the next section 3 under research and development. Now, purchase goodwill. So, internally generated goodwill, purchase goodwill. What happens? When a business is acquired, buyer will pay a price that is more than the fair value of all the asset minus liability. Okay, so this you can separately identify. But this will be dealt according to IFRS 3. Okay, so according to IFRS 3, they require this excess that you are paying over the net asset. So this will be recognized as goodwill and it will be tested annually for impairment. We do not amortize goodwill, we amortize intangible asset, but when it comes to goodwill, we do annually, we test for impairment. So we recognize a goodwill and then we test for impairment. But this will be covered in lecture 23 because it comes under business combination, which is a group accounting, which we are not going to cover in IAS 38. Now, initial measurement of acquired intangible asset. As we told, acquired intangible assets are always recognized. Now, what is the initial measurement? An intangible asset you can acquire separately, part of business as a part of a business combination, way of a government grant, or by an exchange of asset. Okay. Now, so we'll go through each 4 of this in detail now. Separate acquisition. Separately, if I have acquired, this is easy. Just take the cost. So cost of the intangible asset, usually you can measure reliably. So this cost will be determined according to the same principle that has been applied in accounting for your other assets. That includes purchase price plus import duties plus non-refundable purchase tax. Same like IAS 16. Any deferred payments, let's say you are making the payment later, are included in your cash price equivalent. So the difference between this amount and the payment made is treated as interest. As for other assets, your expenditure which will not be classified as cost include those associated with introducing a new product or service. Let's say you are doing advertising and promotion, conducting business in new location or with new class of customer, admin and other general overhead, operating cost and losses, cost incurred in redeploying asset. This cost, remember this type of cost always operating expense in your statement of profit and loss. Okay, this is something which you cannot capitalize as part of intangible asset. These are operating expenses. Now, activity 2, where you have to calculate the cost of the patent rights on initial recognition. So on 31st December, they have succeeded in acquiring the exclusive right to a patent. The amount payable was 600,000 immediately and 400,000 in 1 year's time. You see, this is a deferred payment. And they have some legal fees, 87,000. And there's a stamp duty of 1,000 for registering the patent right. And discount rate is 10%. Now calculate the cost of the patent right. Cost of the patent right means they are telling you what you can capitalize as a part of intangible asset. So this is the solution. First, we'll add the cash paid. This is easy, 600,000. Okay. Then, remember this 400,000 in 1 year's time you have to discount. You have to find the present value. How do you find it? By using the discount rate. Since it's 1 year, so it's 1 divided by 1.1 because 10% into 400,000. This is how you find the present value. 1 divided by 1 plus the discount, that is 10%. So 1 plus 10% is 1.1 to the power 1. They did not show to the power 1 because it's the same. So this is the present value. This 400,000 would be worth 363,636 in today's time. Then we have, that is your deferred consideration. Then we have legal fees. Yes, you have to capitalize 87,000. Then stamp duty 1,000 also capitalize. So cost on initial recognition is the total of this. Now, business combination. When you're acquiring intangible asset through business combination, this is at fair value at the date of acquisition. So the cost of your intangible asset, if you have acquired in a business combination, will be the fair value at the date of acquisition, irrespective of whether the business acquired the acquiree had recognized it before the business combination. It doesn't matter what your acquiree used to recognize the intangible asset at before the business combination. Whether they used to recognize at fair value or at cost, doesn't matter. You have to recognize it at fair value at the date of acquisition. So the fair value of intangible asset acquired, this can normally be measured with sufficient reliability to be recognized separately from goodwill, and will reflect the market participants' expectation at the acquisition date about the probability of future economic benefit. So in this case also, getting fair value is easy. If ever you have to use the fair value under business combination, they will provide you in the question with the fair value. Do not worry about calculating the fair value. Next, third scenario, when you are exchanging asset. So the cost of an intangible asset acquired in exchange for a non-monetary asset or a combination of monetary and non-monetary is measured at fair value. This is also fair value unless the transaction lacks commercial substance, or fair value of neither asset received nor the asset given up is reliably measurable. If the acquired asset is not measured at fair value, then you have to use the cost. Your cost will be measured at the carrying amount of the asset given up. An exchange transaction that has a commercial substance, if, for example, there's a significant difference between the risk, timing, and amount of the cash flow from the asset received and those from the asset transferred. See, how do you know commercial transaction is there or not? Substance is there or not? There should be a difference, and difference should be big enough between the risk that you are facing, for example, timing, and the amount of cash flow between the asset transferred and the asset that you have received. Okay, higher the difference, commercial substance is there. Lower the difference, no commercial substance. Now, usually they give you a scenario in the exam with commercial substance most of the time. Okay, now subsequent expenditure. So after initial comes the subsequent. This is easy because they give you a choice. So in most cases, your subsequent expenditure does not increase your carrying amount of an intangible, because most subsequent expenditure will maintain your expected future economic benefit in an existing intangible asset and do not meet the definition of an intangible asset and IAS 38 recognition criteria. That means any subsequent expenditure you can't capitalize as a part of intangible asset. It's difficult to attribute the subsequent expenditure directly to a particular intangible asset. Therefore, only rarely will you ever see your subsequent expenditure added to the carrying amount of the intangible asset. So normally what happens? Subsequent expenditures are recognized as an expense in the operating category of your statement of profit and loss. Why operating category? See, earlier this operating category, all these things were not there. But now, after the introduction of IFRS 18, your income statement you have to divide into 5 categories. The first one is operating category. So we use intangibles, goodwill for our trading purpose. That's why operating category. Now, internally generated intangible asset. The third section will deal with all internally generated intangible asset. Forget about what you have acquired for time being. Okay. So how do you recognize internally generated intangible asset? It is sometimes difficult to assess whether an internally generated intangible asset qualifies for recognition. Okay. It is difficult to determine whether there is an identifiable asset, future economic benefit are probable, and cost can be measured reliably. So let's say it's very difficult for you to distinguish the cost of generating a brand, for example, from the cost of developing the business as a whole. You can't find out, you can't find the difference between two because brand is with the business. So maintaining goodwill or operating on a day-to-day basis is difficult. Therefore, internally generated brand, mastheads, publishing title, customer list, items that are similar in substance, you can't recognize as an intangible asset. In short, internally generated intangible asset, you do not recognize as an intangible asset. So what does IAS 38 says? That all other internal costs that may result in an intangible asset will be treated as either research or development. Now we'll go to research and development in depth. IAS 38 requires the following is applied to all the internally generated intangible assets. Generation of the asset must be classified into research phase and development phase. When you start building a new asset, it is divided into two phases. One is research phase, one is a development phase. Very important. And if you can't clearly identify which is the research phase, which is the development phase, then you only have to regard it as a research only. First, we'll see the accounting in the research phase, then we'll move on to accounting in the development phase. Accounting in the research phase. First, let us understand what is the meaning of research. Of course, definition they will not ask you in the exam. You don't have to worry about it at all. But knowing it will help you to differentiate between research and development. Otherwise, you will get very confused and think they are the same. They are not the same and they are not treated in the same way. Research is anything that is original, planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. Why do you do a research? To get a new information. So during the research phase, it is not possible for you to demonstrate that an intangible asset exists, which will give you a future economic benefit. So therefore, the conclusion is this: expenditure on your research is always operating expense. Always it is expensed as an operating expense. Now, these are the examples of your research activity. Activities aimed at obtaining new knowledge, the search for evaluation and final selection of applications of research findings, search for alternatives. For example, you want to find the alternative material, device, product, process, and the formulation, design, evaluation, final selection of possible alternatives for new, improved material, device, product, process. All these are research activities which are expensed. Moving on to the development phase. What is development? So the definition of development is, it is the application of research finding. First you have to do the research, then only comes development. Based on the research findings, you are going to develop now. So now you are going to apply the research findings or other knowledge to a plan or design for the production of new or improved material, device, product, process, system, or service before you start the commercial production. An intangible asset that arises from development must be recognized if and only if specified criteria are met. But before going to those criteria, first let us go through the examples of development activities. If these activities are there, they are development. Design, construction, testing of pre-production or pre-use prototypes. Design of tools, jigs, molds, dies involving new technology. Design, construction, operation of pilot plant, which is not of a scale economically feasible for commercial production, and design, construction, testing of chosen alternative for new improved material, device, product, process, system, or service. See, this is more like testing phase. Okay, development is more like testing phase. Research is like first time you are obtaining new information. In short, now accounting. So all this criteria has to be met for you to recognize it as a part of intangible asset in the development phase. First, your expenditure has to be technically feasible. That means technical feasibility of completing your intangible asset so that it is available for use or sale. Next, you should have the intention to complete your intangible asset and use it or sell it. There should be an ability to use or sell the intangible asset. There should be a probability of future economic benefit from the intangible asset. Then the availability of adequate technical, financial, and other resources to complete the development and use or sell the intangible asset. And the ability to measure reliably the expenditure to the intangible asset during its development phase. In short, it is known as PIRET. Okay. P stands for probable, I stands for intention, R stands for resource, A stands for ability, T stands for technical, and E stands for expenditure. The acronyms are PIRATE. All has to be one, not just one. Cost can only be recognized as an asset in the development phase. Okay, see, research phase is always expense, but in the development phase, you can only recognize the cost as an asset from the date all the 6 criteria are met until the date asset is complete. Outside this period, all your costs must be recognized as an operating expense in your statement of profit and loss. Research cost and development cost, before the recognition criteria were met, must be recognized as an expense. See, before meeting the recognition criteria, all your research costs and development costs are as an expense. This cost, you can never transfer them to be part of the cost of an intangible asset at a later date when you're meeting the recognition criteria. When you're meeting the 6 criteria later on, you can't say now I'm going to capitalize the expenses as the cost of intangible asset. That you can't do. It will always remain as an expense. Now, example 2. So example 2 will help you to understand this better. An entity is developing a new production process. This is the expenditure from 1st Jan to 30th November, from 1st December to 31st December. Okay. So on 1st December, the entity is able to demonstrate that production process met the criteria for recognition as an intangible asset. So what happened? The amount that is estimated to be recoverable from the process, including future cash outflow to complete the process before it is available for use, is 1,200. Now, let's do the analysis. Which will be expensed, which will be taken as the part of intangible asset. So, at 31st December, okay, let's do the analysis. At 31st December, the production process was recognized as an intangible asset at the cost of 240. Why 240? Because this is the date when you have met the recognition criteria. That is 1st December. So your intangible asset will be measured at its cost because it is less than the recoverable amount. Let us go back and check. See, they have told very clearly here that on 1st December, they are meeting the criteria for recognition as an intangible asset. So from 1st December to 31st December, that is this 240, you will take as a part of the cost of intangible asset. And if you compare this with your recoverable amount is 1,200, whereas cost is 240. So the lower of the two. So you have to take the cost. That is 240. Okay. Now, what about this 2160? The 2160, you can never capitalize it. Okay, that 2160 will go as an expense. Okay, because it was incurred before 1st December when you have met your criteria. So it will be recognized as an expense and it will never form part of your production process cost. That will go in the statement of financial position. It will go in your statement of profit and loss as operating expense. Now they have given the following information. The expenditure in 2007 is 4,800 and at 31st December, the recoverable amount is 4,500. Okay. So now see, any expenditure incurred after you have met the criteria will be taken as a part of the cost of the asset. So this 4,800 will be added with this 240. Okay, like this. So now your total production process cost is 5,040. You have to compare this with the recoverable amount. When you compare it with the recoverable amount, you see there's a difference of 540. It's a loss. It's an impairment loss. Okay. So this impairment loss will be reversed in the subsequent period if you are meeting the requirement of IAS 36. That is impairment of assets, which we are going to cover in the later lecture. So now, cost of an internally generated intangible asset. The cost of internally generated intangible asset will include all the directly attributable cost that is necessary for you to create, produce, prepare asset to be capable of operating in the manner intended by management. For example, the fees to register a legal right, depreciation of equipment used in the development phase, and amortization of patent license used to generate intangible asset. All this will be your cost of internally generated intangible asset. Now, the cost of internally generated intangible asset will not include this. Inefficiencies and operating losses. Cost previously expensed during research phase and training expenditure. Now, expenditure incurred to for which no intangible asset can be recognized. Okay, it will be recognized as operating expense. That means this expenditure, if you are incurring, it is taken as an expense, operating expense, not as a part of intangible asset. They are your research cost, pre-opening cost for a new facility. If you are incurring any cost before you open a new facility, known as pre-opening cost, they are expenses. Then plan startup cost incurred before full-scale production, legal and secretarial cost incurred in setting up a legal entity, training costs involved in running a business or a product line, and advertising and related costs. These are expense, not intangible asset. Training cost. See, why can't we capitalize the training cost? Even though we might say that because of training, it is going to bring us future benefit. But see, you cannot separate the training from the entity. And company can't retain any legal or contractual right on training also. Staff can leave your employment at any point. Okay, therefore employer cannot restrict the access of your staff to another company. Okay, note that although certain cost you cannot recognize as intangible asset, but a prepayment can be recognized when the payment for good and service has been made in advance of the delivery of good or the rendering of services. So in particular, a prepayment asset can be recognized for advertising or promotional expenditure. That is, example, mail order catalog, up to the point at which entity has the right to access the good purchased or the point of receipt of service. Now, now let us go on to the fourth part, that is the subsequent measurement of intangible asset. There are two measurement models for intangible, known as cost model, revaluation model. Again, it's the same thing. Since IAS 16, we have been going through the same. Even IAS 16 has that, IAS 40 also has that. Cost and revaluation model. Entity can choose. But revaluation model is only available in limited circumstances for intangible. First, let us go through the cost model. Cost model, we take the cost minus depreciation minus impairment loss. Revaluation model, where we revalue the intangible assets. So we look at the fair value, less any depreciation and less impairment loss. Fair value must be measured by reference to an active market. I have already told you what is the definition of an active market when I explained to you IFRS 13 fair value under my conceptual framework lecture 2. Let me tell you again. Active market is a market where the transaction for your asset or liability is taking place with a big amount of frequency and volume is high. So because the frequency is high and volume is high, it is giving you a pricing information on an ongoing basis. It's easy for you to get a price. There is an active market for it. So the requirement for an active market means most intangible you cannot revalue by nature because they are unique. For example, if it's an internally generated goodwill or your brand, it's very difficult for you to get an active market for it because it's very unique. So intangible asset that may be revalued, including operating license. For example, you are having a license to operate a taxi in a large city. Okay. So several identical licenses exist and they will be traded regularly. So how do you get the revaluation for intangible assets like operating license? You will see the price of the several identical licenses that exist that are traded regularly. So based on that, you can find the fair value, things like that. So see, when it is IAS 16 or IAS 40, that is investment property or property, plant and equipment, getting a active market is easy. But when you come for intangible asset, you have to be a little careful. You have to be cautious. Okay. Here, goods are unique. Most of the time, your intangible asset might be unique. It's difficult for you to get an active market. So in that case, you can't go by the revaluation model. So where if you're applying the revaluation model, you have to do it frequently. So your carrying amount is not materially different from the fair value. Now, revaluation will be carried out by using the same principle that we have identified in IAS 16. For example, these are the same things I've told in IAS 16 also. I'm repeating once again here. So all of those who have missed out my IAS 16 lecture, please pay careful attention right now. I'm repeating it once again. So you can apply the same for IAS 16 and also the standard IAS 38. When there is an increase in the carrying amount, increase in the carrying amount means revaluation upwards. It will be recognized in OCI, other comprehensive income, and it will be transferred to a revaluation surplus in your equity. But not always. If you are having a decrease of revaluation previously, that was recognized in profit and loss, then now if it's increasing, that increment first you have to adjust with the amount in your P&L. Then the balance will be recognized, the excess will be recognized in OCI. Next, if there's a decrease, if your revaluation went downwards, you will recognize it in your profit and loss as an operating expense, unless there was a surplus before in your OCI. So first you will adjust in OCI, then P&L. Any balance on your revaluation surplus in the equity will be transferred to the retained earnings when you are realizing the surplus. How do you realize the surplus? When you are selling that asset. When you are selling the intangible asset, any revaluation of surplus that was there before, transfer to retained earnings. So revaluation surplus debit, retained earnings credit. And your revaluation model has to be applied consistently to all the assets of the same class. I'm not saying all the assets of all the class. No, same class. If they're in the same class, if one asset you have revalued, all the asset in that class has to be revalued. Let's say machinery. All your machinery items have to be revalued. But let's say your vehicle, motor vehicle category, you're not revaluing, then it's okay. So some are in cost, some are revalued because they are in different classes. Now, purchased brand activity 3. Okay, so you have to explain the recognition, initial measurement and subsequent measurement of the brand. So in 2003, Easter has acquired the mail brand from Malice Center for 2.1. They can sell the product under the brand and use their web domain name. They did not acquire any other assets of the business. So in this case, first we'll go by the definition. Yes, the brand is separable because you have acquired it separately from the remainder of the business. Number 1. Number 2, second definition, it's a non-monetary asset. And third definition, no physical substance. See, when you answer, now is the time that you should know how to answer. It's very important. First, always start with the definition because they are telling you the recognition, right? Start with the definition of intangible asset. What are the 3 keywords of definition of intangible asset? That you will start first. First, you have to say whether the brand is separable, non-monetary, and physical substance is there or not. So all 3 you have answered. It's separable, it is non-monetary, and no physical substance. First point over. Second point. Now it have met the recognition criteria. How it will be recognized? Question the how. Answer the how. It would be recognized as an intangible asset in the statement of financial position. Where do we recognize intangible asset or any asset? In the statement of financial position. Of this 2.1 million. Amount is given, write the amount. Always write the amount and always write the correct place under the correct heading. So, statement of financial position. Very important. And at this amount. And journal entry, wherever you can give journal entry. If you are very sure of your journal entry only, then give. If they are not asking for one. So debit your intangible asset because it's an asset will go up, and credit your cash because you are acquiring with, of course, cash. Next, they told initial measurement and subsequent measurement. So after recognition, the second para. After recognition, there is a choice. The brand would be held under the cost or the fair value model, but they did not mention anything about fair value or any other market like that. This they have acquired from a company. That is not a separate accusation. So that's why this brand would be held under the cost model. Very important. You have to write evaluation of cost model. And its useful life. See, when you write its cost model, next is useful life, whether finite or indefinite. Finite means they will give you the number of years. Indefinite means forever. So useful life could be finite or indefinite. If finite, so since information is not given to you, you have to say if it is this, this is the rule. If it is this, this is the rule. So if it's finite, fixed number of years, you have to amortize. It's an intangible asset. So goodwill we do not amortize, but other intangible asset we amortize. Like how we depreciate non-current asset, tangible asset, we amortize intangible asset. So we would amortize. Otherwise, it would be subject to an annual impairment review. If, say, it could not be held under the revaluation model. Very important. If you are very sure it cannot be held under certain measurement, you have to write that. It cannot be held under the revaluation model. Why? Because the brand is unique, like Malice brand. So because the unique is brand, there is no active market to give you a fair value. Okay. Now, coming to the useful life. Very important. Once you have identified that this is an intangible asset, next question is the useful life, because you have to amortize it. Same like depreciation. So determining the useful life of an intangible asset. First question, whether it has a finite or indefinite. Finite means time period is limited. Okay. And you have to amortize it. Indefinite means there is no possible limit to it. So that's why an intangible asset with an indefinite useful life, you cannot amortize it. Now, factors that affect your useful life. So useful life will be based on the analysis of all of the relevant factors, including your expected usage of the asset, typical product life cycle of the asset, public information on estimates of the useful life of similar types of assets, technical, technological, commercial or other obsolescence. For example, computer software, they usually tend to have a shorter useful life. And stability of the industry in which the asset operates. Based on this, you can assess the useful life of intangible asset. Now, then we have changes in the market demand for the output, expected actions by competitors, the level of maintenance expenditure or funding required, and the entity's ability to intend to reach this level, legal or similar limits on the use of assets such as expiry dates of related leases, and whether the useful life of the asset depend on the useful life of other assets. Now, contractual or other legal right. The useful life of an intangible asset that arises from some rights, for example, contractual or other legal right, should not exceed the period of such rights. It may be short. Okay. See, for example, your intangible asset life is 5 years. Contractual right is 3 years. Then you have to take the shorter of the two. Then your useful life of intangible asset would be 3 years. Okay. Sometimes you can renew this right. Okay. So where such rights are renewable, the useful life includes the renewable period. Then you have to take the renewal period into account in your useful life. If there is an evidence that entity will renew it without a significant cost, evidence that the entity will renew without significant costs may be based on the experience or third party concern. This is something which you can say based on your experience or third party concern. If the cost is significant, it will represent a new intangible asset. Remember, if the cost of renovation is significant, it's a new intangible asset altogether. Next, so let us see the two examples, example 3 and example 4. In example 3, useful life of a legal right. An entity has purchased an exclusive right to operate a passenger and a car ferry for 30 years. There are no plan to construct tunnel or bridges to provide an alternative river crossing in the area that is served by the ferry. So the ferry, would be the useful life of the ferry? Same as your exclusive right, that is 30 years. The next example. Example 4. Useful life of a contractual right. Entity has purchased a right to operate a wind farm for 40 years. Cost of the wind power is much lower than that of the alternative power sources. So the surrounding geographical area, it is expected to demand a significant amount of power from the wind for at least 25 years. Tell me which one. Would it be 40 years or 25 years? It is shorter of the two. 25 years. So your wind farm will be amortized over 25 years, not 40 years. Shorter of the two. Now, amortization. If you are having an asset with a finite useful life, question is amortization. So you have to amortize over the useful life. Accounting for amortization is the same for depreciation, where the depreciable amount of an intangible asset will be allocated on a systematic basis over the estimate of its useful life. Amortization begins when the asset is available for use. Same like depreciation. Amortization cease at whichever is the earlier of the date that the asset is classified as held for sale or derecognized. Remember, if you are selling an asset, your asset is derecognized, so your amortization also will stop. Or if your asset is held as classified as held for sale, you will apply IFRS 5 and you will stop amortization. So either of the two, whichever of the two is taking place earlier, on that day amortization will stop. Now, amortization will not stop when an intangible asset is lying idle. Temporarily it is lying idle unless it is fully depreciated. Amortization pattern should reflect the pattern in which your assets economic benefits are expected to be consumed. Okay, if that pattern cannot be determined reliably, use straight line method. Mostly straight line method only we use. In your exam also they give you the straight line method for amortization. They do not make the calculation of amortization so difficult. It's easy. So amortization for each period will be recognized in your profit and loss unless another standard or permits its inclusion in the carrying amount of another asset. For example, amortization of a patent right that is exercised in manufacturing will be taken as a part of inventory cost. You see, it is inventory is your asset. It is taken as a part of another asset, carrying amount of your inventory, your amortization. But unless it is so, amortization is normally expensed in profit and loss. And this usually happens when it is done in the manufacturing sector. Anything to do with manufacturing sector will be taken in a part of an inventory cost. Only in that scenario. But if you are not given a case study based on a manufacturing industry, then it is easy, amortization expensed. Now, residual value. With amortization or depreciation, we have residual value. So residual value of an intangible asset, it is assumed to be zero unless the following conditions are met. There is a commitment by a third party to purchase your asset at the end of its useful life, or there is an active market for the asset, and residual value can be measured reliably by referring to that active market, or it is probable that such a market will exist at the end of useful life. In this case, your residual value will not be zero. Otherwise, it is zero. Whether your residual value is zero or not, question will make it very clear. If there is a residual value, they will give you the amount. If they do not give, or if they are silent about the residual value, it is zero. Assume that it's zero. Now, if the residual value of your intangible asset increases to an amount equal to or greater than the asset's carrying amount, what happens? Your amortization will be zero. It can't be negative. It is zero. See, it is the carrying amount minus the residual value. Okay, but if the residual value is more than the carrying amount, what happens? Amount becomes negative. But it can't be negative. Amortization expense can be zero unless and until its residual value subsequently decreases to an amount below the asset's carrying amount. Okay, what does it mean? Residual value has to be less than the carrying amount. In that case, that difference between the amount, carrying amount and the residual value will be your amortization. Otherwise, in all case, if residual value is equal to or is more than the carrying amount of your intangible asset, amortization is always zero. And if residual value is less, the difference is your amortization. Remember this. An asset with a residual value implies an intention to dispose of it before the end of its economic life. Therefore, development costs are unlikely to have a residual value other than zero. Now, review of your accounting estimate. The amortization period and the amortization method, both you have to review at the end of each financial year end, and any changes in the period or the method will be accounted for prospectively according to IAS because this is a change in accounting estimate. Now, let us go through activity 4 where you are supposed to calculate the amount of research and development expenditure to be recognized as an expense. So, on 1st Jan, Brook established a new research and development unit to acquire some scientific knowledge about a chemical for pain relief. Okay. Now, they have purchased a building for 400,000. Building was depreciated on a straight line basis for 4%. Wages and salaries of the research staff are 2,355,000. Then scientific equipment cost is 60,000, depreciated using reducing balance rate of 50%. So now, when you're writing the cost, you have to write those costs which you are going to capitalize. So first, sorry, you have to write those which you're writing as an expense, not capitalize. So in the building, the building depreciation will come as an expense. So it's on a straight line basis. So just apply 4% on 400,000. You get the depreciation 16,000. Coming to the wages and salaries, you can take as it is, that is 2.355 million, and the reducing balance basis, that is take the equipment depreciation. So 60,000 into 50%. Your total cost is 2.4 million. Now, activity 5. Assuming there is no impairment, you have to determine the maximum amount of your development expenditure which you can carry forward under IAS 38. What does it mean? It simply means amount that you can capitalize as part of intangible asset, not expensed. Okay, so here in the first year of trading, they have acquired this expenditure. 12,000 on successfully devising the process to cover the sap extracted from mangroves into chemical XYZ, and 60,000 on developing a medication based on chemical Z. No commercial users have been discovered for chemical X and Y. Now, the commercial production and sales of analgesic have commenced on 1st September, and they are expected to produce steady income for 5 years before being replaced, and adequate resources exist for the company to achieve this. Why did they give you this? In order for you to see whether you fulfilling the criteria for your development cost to be capitalized. That's the only reason. So now in your cost, first let us go through the 12,000. Your 12,000 cost would be your research expenditure. So it will be expensed. You cannot capitalize under any circumstance. So it will go as an operating expense in your statement of profit or loss. Next is about the 60,000. This is initially recognized. This 60,000 you will capitalize, and your residual value is 0. Okay, and so we have finished the cost part. Always first finish the cost part, then the amortization, then the carrying amount. Okay, so next is the amortization. So you will amortize this 60,000 for 5 years. Okay, and for how many months? For 31st December. And you have, and it, see, you can only do the amortization when the asset was brought for use, that is from 1st September. So September, October, November, December, only for 4 months out of total months. In 5 years, 5 into 12, there are total 60 months. Out of those 60 months, you can only expense the 4 months, that amortize only for 4 months, because we want to get the carrying amount at 31st December. Okay, that's why we are doing it. So 4 divided by 60 months into 60,000. Your 4,000 is your amortization expense. So simply deduct 4,000 from 60,000. 60,000 is the cost, 4,000 is the amortization. The carrying amount is 56,000. And if there is any impairment, that impairment will be deducted, and your cost will go, carrying amount will further go down. Now, activity 6, where you are developing a new product. So here you have to explain how the development expenditure would be accounted for in the financial statement. So it's about Brooke spending 2 million on developing some new line of food for infant nutrition. And on 1st Jan 2005, they have approved to fund the rest of the project. And the further 1 million was spent in the first quarter of 2005. On 1st April, they have applied for a infant food license, and it was rejected because it did not comply with the standard. Brooke spent a further 1 million in the second quarter, and FSA has approved the reapplication of the license on 1st July 2005. They have spent a further 1.5 on developing the product before its launch on 1st October. The new product line will generate revenue which will be more than 20 billion and useful life of 5 years. Okay, so now, very important. First, so Brooke will recognize only this 1.5 million. Okay, we'll recognize only the 1.5 million of expenditure as the cost of intangible asset. Okay, that also from 1st July 2005, because from this day onwards all the development criteria has been met. Okay, even though the asset was likely to generate a significant benefit and the total of 5.5 cost has been incurred. If you see the total cost, how do you get the total cost? It is 2 million here, 1 million 3 plus another one 4 and 1.5. So total 5.5 million. The cost incurred before 1st July you cannot capitalize. And the 2 million that has been expensed in 2004, you cannot recognize it now as a cost of intangible asset. Nor the 2 million incurred in the first 6 months of 2005, that must be expensed. So the amount that you have expensed before 1st July has to be expensed only. You can't now take it as a part of intangible asset. Okay. Now, as the product range was launched on 1st October, you will start the amortization. Why do you need the date of the product launch? To start your amortization. That's why you need. Amortization will start from 1st October. Your capitalization will start from 1st July because you are meeting all the criteria. You have got the approval of license to carry out on 1st July. That's why. But amortization will not begin on 1st July. It will begin from 1st October. Okay, because you have to spend a further 1.5 before you develop the product range. Before its launch, it has to come into launch the product, then only you can amortize. Okay, so now amortization, how much would be the amortization? It will go as an expense in your P&L. It is simply for 3 months, that is October, November, December, because we are finding for 31st December. So from October, 3 months of what is the amount? You have spent 1.5 million. Okay, that 1.5 million that you have capitalized only you can amortize. Divide by 5 years. So this is the working and you will get 75,000. Remember this 1.5 is million. Okay, 75,000 is your expenses amortization, and you have to adjust your carrying amount in your statement of financial position. So from 1.5 million you will deduct 75,000 amortization and your carrying amount would be 1.425 million. And your intangible asset, because it is unique, you cannot revalue. Okay, now intangible asset with indefinite useful life. All this while we have been talking where they are having a definite useful life where we used to amortize. Now what about this? An intangible asset with an indefinite useful life. You can't amortize, but you can test for impairment. Okay. In your exam, you can be given any type of intangible asset with indefinite useful life or definite useful life. But most of the time it is the definite useful life which is tested, because there they can test your amortization. But you have to be prepared for this also. You have to test for impairment annually and whenever there is an indication of impairment. Now, this indication of impairment will go through under IAS 36 when I teach you impairment. Okay, what are the indicators of impairment? Now, when you reassess a useful life as finite rather than indefinite is an indicator that asset may be impaired. Remember, sometimes you change the useful life from, okay, you write the useful life as finite rather than indefinite. So from unforeseeable future, now it is having a limited time like 4 years, 5 years. Then it's an indicator that your asset may be impaired. So the useful life is reviewed each period to determine whether events and circumstances continue to support your indefinite useful life assessment. If an indefinite assessment is no longer supported, you have to change. Okay, you have to change it to definite. So that change from indefinite to definite or finite is accounted for prospectively according to IAS 8. It is known as change in accounting estimate. All these are estimates and you will deal prospectively the current year and the future years. Not, you will not go in the past and change the figure. Now the impairment loss, impairment and derecognition. So goodwill, intangible assets not yet ready for use, and intangible assets with an indefinite useful life. These three things you have to test annually for impairment. You do not amortize. What are they? Goodwill. Number one, goodwill. Number two, intangible assets that are not ready for use, and intangible assets with an indefinite useful life. Test annually for impairment. IAS 36 is the standard for impairment of assets. So IAS 36 is for impairment of assets. It means impairment of all the assets, all the non-current assets, intangible assets, whatever. It is not for specific type of assets. It is for all the assets. If there is an impairment, it will be dealt according to IAS 36. So in this standard regarding when and how carrying amounts are reviewed, how recoverable amount is determined, and when an impairment loss is recognized or reversed. IAS 36 deals with this aspect. The purpose of testing for impairment is to ensure that your carrying amount of an asset can be recovered through the use or sale of the asset. If your carrying amount cannot be recovered, it must be written down to the amount that can be recovered. Note that the uncertainty about recovering the cost of an intangible asset before it is available for use, for example, development cost, is likely to be greater than when it is brought into use, because when it is brought into use, it is easier for you to recover the cost of an intangible asset, but it is more harder for you to recover the cost of an intangible asset before it is available for use. Like development cost, this cost arise before your intangible asset is available for use. Now example 5, one example of impairment, let's say brand. So Atlantic Air is an intelligent airline. 10 years ago, it purchased the brand name of the national airline, Tricolor, for 80 million, and then it declared bankruptcy after 75 years of operation. So AAS management initially estimated the brand name to have an indefinite useful life. It's good. However, because of the unexpected competition that have entered the market in 2001, they are now changing the estimate that the future cash flow that will be generated by the brand name will be 25% less for your future. So the carrying amount of the brand will be written down from cost to the estimated recoverable amount, let's say 60 million. As long as it is still regarded to have an indefinite useful life, you cannot amortize it, but you can test for impairment annually and whenever there is an indication of impairment. Now, derecognition. An intangible asset should be derecognized. That means eliminated from the statement of financial position when you dispose the intangible asset or when there is no future economic benefit from that intangible asset. So when you sell your intangible asset, of course you'll be having a gain or loss that arises. So that gain and loss is the difference between your sale proceed and your carrying amount of the asset. Gain or loss of the intangible asset will be recognized in the operating category in your statement of profit and loss. Gains are not classified as revenue. Remember, revenue under IFRS 15, you will keep it separate. Gains are separate. Now, disclosure, the last part for this standard, disclosure. Disclosure of intangible asset, general, okay? Financial statement should disclose the accounting policies that intangible assets have adopted for each class of intangible asset, whether useful lives are indefinite or finite, and if it is finite, the useful life or the amortization rate used, amortization method used, the gross carrying amount, and any accumulated amortization, including the impairment loss at the beginning and at the end of the period, have to be reconciled. Then, disclosure of intangible asset with indefinite useful life. The note must disclose the carrying amount and the reasons why you are thinking that useful life is indefinite. Then, if you have acquired by a way of government grant, you have to disclose. So, any intangible asset that you have acquired by a way of government grant, by the way, government grant I have covered under IAS 20, you can initially recognize them at fair value, but the notes are required to disclose the fair value initially recognized for these assets, their carrying amount, and whether they are measured after recognition under cost model or fair value model or evaluation model. Then, disclosures for revalued intangible asset. Following should be disclosed for each class of asset that are carried at revalued amounts. The effective date of the revaluation, carrying amount of the revalued intangible asset, carrying amount which would have been recognized using cost model, amount of your evaluation surplus relating to intangible asset at the beginning and end of the period. Also indicating movement in the period and any restrictions on the distribution of the balance to the shareholder. Disclosure for research and development expenditure. The note should disclose your total cost of research and development expenditure recognized as an expense during the period. Now, that's it. So from the syllabus, we are still in section B. Point number 2, intangible non-current assets. See, point number 1, we were in number 1 in all this white from IAS 16, IAS 20, IAS 23, IAS 40. All this whole lecture was focusing on tangible non-current asset. This lecture is focusing on intangible non-current asset. So here we have discussed the nature and the accounting treatment of purchased intangible asset and internally generated intangible asset. There are two types. Next, we have distinguished goodwill from other intangible assets. Then we have discussed the criteria for initial recognition and measurement of those intangible assets. Then we have described the subsequent accounting treatment and we have applied the relevant IFRS, that is IAS 38 to research and development. Now let us summarize. So we have started the lecture by saying intangible asset has three parts to its definition. It is identifiable, non-monetary asset without physical substance. Essential attribute means attribute is that it should include control. Okay, and intangible is identifiable when it is separable or arises from right. An item is recognized when it is meeting the definition of an intangible asset. What are the definition? Probable inflow of economic benefit and cost can be measured reliably. Acquired asset meets the recognition criteria, but internally generated asset will be treated as research and development. Intangible can be acquired by purchase, grant, exchange, or internal generation. 4 ways. Intangible assets are initially measured at cost. Items that are expensed are brands and internally generated goodwill, and cost of startup, training, advertising, relocation, all these are expensed. Subsequent expenditure will be expensed when incurred. For internally generated intangible asset, research costs are expensed, development costs are expensed, but they can be recognized as an expense if certain criteria are met. And for subsequent measurement of recognized intangible asset, you can use cost model or evaluation model. Apply the evaluation model only if the fair value exists in an active market, which is rare. And you have to assess the useful life as definite or indefinite. If it's definite, amortize. Indefinite, do not amortize. Amortize to reflect the pattern of consumption or otherwise straight line. Test annually for impairment. Assets that are not yet in use. Disclosure requirements are very comparable to your IAS 16 also. So basis for determining an indefinite life, description and carrying amount of individual assets that are material, amount of research and development expensed. Now the technical articles that you must read, that is intangible assets, can't touch this. This is on your ACCA website. All you have to do is you have to go to financial reporting, click there and go to technical articles and go to intangible assets, can't touch this, click it and start reading it. Thank you for watching and I shall see you in the next lecture with a new standard, and next lecture is going to talk about IFRS 5, non-current assets held for sale. So we are still in the non-current asset section. Thank you for watching.